Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra, and this is a special edition. Now, last few years were quite challenging for the fixed income investors. Ever since we saw the COVID-19 pandemic break out, central banks across the globe worked hard to really boost their economies by cutting the policy rates. And this in turn lowered the yields and made the overall fixed income products, including the bank FDs and the small saving schemes, offer poor returns to investors. But this scenario changed over the last 1 year, where we have seen hawkish tones and aggressive rate hikes by central banks across the world, including that in India from the RBI, where the repo rate has now reached the pre-pandemic levels yet again. So what does it really mean for you as an investor? Should you now take a relook at your portfolio and also perhaps even look at increasing your allocation when it comes to the fixed income products? That's going to be the focus of our discussion in this show today. Joining in on this show will be with me Mr. Vishal Dhawan, founder and CEO, Planner Head, Wealth Advisors, and also joining in will be Teena Jain Kaushal, editor, Money Today, with me, my colleague. Welcome, Mr. Dhawan, and welcome, Teena, and thank you so much for taking the time out for this discussion. So let me start off with you, Mr. Dhawan. What exactly, as a basic, very basic question for all our viewers to really get this benefit, what exactly do we mean when we talk about fixed income options? And in the current scenario, when we have been seeing the rising interest rates, do you really think compared to equities or other assets, fixed income options have become more attractive?
Thanks for having me over. So I think, there are two very important things around fixed income. One is that there are fixed income instruments which are truly fixed in terms of rate of return, which means that as long as you hold it till its maturity, you will get a definitive rate of return on that instrument. And then there are other fixed income instruments where you don't know exactly what you will get, but the likelihood of getting returns in a sort of small range is very high. And therefore, when we put sort of fixed income strategies together, you may deliberately look at combining those which are truly fixed as well as those which have very, very little sort of volatility.
Okay.
Coming to your question around, does fixed income really become more attractive? We definitely think so. We need to remember that, when the pandemic broke out, one of the most important things that central banks all over the world did, including in India, is cut rates very, very aggressively. And what it resulted in is inflation gradually picking up across the world. And suddenly you found that prices had become much higher than what they were. And therefore you've seen all the central banks actually reverse out action, saying, let's go back and look at this trade-off between growth and inflation. And let's make it such that the rates of return that investors make on fixed income are actually positive after accounting for inflation. And I think that's a very, very important piece, because ultimately, if you want to, grow your money, you need to be able to make a rate of return which is higher than what inflation is.
Very true.
And that makes it a very, very real option at this point.
Okay. Teena, let me come to you and toss the similar question to you. What is the trend that you've noticed? Have you noticed any shift of preference among people? Have people begun to invest more in fixed income options over the last 1 year with the rising interest rate scenario?
Hi, Sachi. Definitely, there has been a growing interest of people in fixed income instrument. For example, if I talk about fixed deposit, the rates have risen during the last 1 year because of rise in repo rate and therefore the rise in interest rate. So definitely, banks have also gone very aggressive because they want to grow their deposit base to match with the credit base. So definitely, there has been a growing interest. Also, we recently saw that small saving rate also has gone up. It is gone up to become as attractive as FDs are. So definitely people are talking about the higher interest rate and people are actually booking FDs. So because this number is reflected in the growing deposit base of banks.
Okay. Mr. Dhawan, let me just take all these options one by one to make, to give more clarity to all our viewers right there. If they want to increase their allocation in any one of them, how should they be really approaching in terms of the tenures that is required to be invested in, the interest rates that are being offered currently, the risks and the reward, and the liquidity measures as well. So let's start off with the very basic, the bank and the small finance bank deposits as of now. So over here, if you could help us understand the kind kind of tenures that one gets as an exposure to deposit their money in these accounts, and also what is the kind of rate of return that one is getting these days?
Sure. So I think it's important to understand, first of all, the difference between what you get off a bank deposit and a small finance bank. Because essentially, because the word bank is sort of associated with both of these, there is a tendency for a lot of investors or depositors to believe that they are ultimately, as safe as each other.
Sure.
What we need to remember is that with bank deposits, most of the traditional banks that people have been banking with over the years, their lending happens in multiple segments. So they lend to the biggest corporates, they lend to retail individuals who are taking home loans, car loans, etc. And then they, therefore have a blended sort of book of where they're lending out their money. Now, the moment you have a very blended book, you're likely to have a lower risk because you're very, very diversified in terms of the segments that you're working with. In contrast, small finance banks tend to focus on the SMEs, and therefore the risk with which they probably lend is going to be a little higher, because what's ending up happening is they will charge a premium for taking on that risk. And therefore, when you see deposit rates being higher in small finance banks, you need to remember that very often their lending book could also be more aggressive as compared to a traditional bank. If you look at bank deposits in general, they are very, very liquid instruments, which means that whenever you require the money, you can actually make a request to take the money out. And that's the big plus about deposits, because whether it's an emergency fund, whether it's a short-term goal that you're saving for, bank deposits work really well. The rates of interest are ranging anywhere between 6.75 to about 8% in the traditional banks, and it's about 1% higher in the small finance banks at this particular point. On top of that, if you're a senior citizen, you'd probably get another maybe 0.5% more, as a sort of bonus for being, a senior. I think
Sure.
what's very, very important to remember with bank deposits is that you do need to ensure that you're definitely clear about the tenure that you're putting this deposit away for. Because what banks do end up doing is, if you withdraw prematurely, they will charge you very often a penal interest. And what is not known is that penal interest is for the corresponding period that the deposit has run for, and not for the originally contracted rate of interest period.
Okay.
And I think that's something that someone needs to keep in mind, because let's say if you looked at the bank deposit rates today and you found that, say, 7% is the most attractive rate for 2 years, and a 1 year deposit is giving you only 6%,
Correct.
you could end up saying, you know what, let me go and keep the 2 year deposit. If I need the money after 1 year, I'll break it. Now, when you break it after a year, instead of getting 7 minus 1, which is 6, you'll actually get 6 minus 1, which is 5. And therefore, it's important to try to get your tenure right when you're
Yeah.
buying a bank deposit.
Very important right there for all the investors to note there. When you're going and selecting a tenure, please do select it, and then abide by it, because premature withdrawals will definitely attract some penal interest right there. Teena, could you also come in on the bank and small finance bank deposits, as far as the risks have already been highlighted by Mr. Dhawan? If you could talk about the taxability factor right here that investors must keep in view.
Yeah, definitely. Taxability is an important part. So in bank FDs, what happens is your interest amount is taxable. So whatever your interest amount is, it will be get taxed according to the tax slab you fall into. So if you fall into 10% tax slab, your interest will be taxed at 10%. If you are in 30%, then it will be taxed at 30%. So it all depends on your tax slab, and that's why the people who are into 30% bracket, for them FDs is bit costly because of the high tax rate.
Okay, okay. Let's also talk about, you talked about a little, higher risks in the small finance bank deposits, especially for SMEs, Mr. Dhawan. Let me also bring in right here corporate fixed deposits. I mean, I wanted to understand from you, are these options getting increasingly popular among the investors to explore? And what are the risks that one should be aware of? One goes and explores, even though the rate of interest may be much higher. And perhaps, the tenure is about 1 year to 10 years as well. The interest rates now being offered are perhaps upwards of 9%, which is very, very interesting. And compared to equities, by taking so much risk also, last year we only got about 4%. So it has definitely beat that by a huge margin again. So compared to that and the risk factor, how should one really approach the corporate fixed deposits right here?
So again, on corporate deposits, it's important to break them into two categories. One is those which are issued out by NBFCs, which will typically be rated. And therefore, when you have independent ratings there, you are better protected traditionally, because the probability of a default of a high rated deposit is lower. Not that it's never happened, but it's a lower probability. So ideally look for higher rated deposits. They don't give you about corporate deposits. They give you about 1% over what you will get on a traditional bank deposit, maybe going up to 1.5% in certain cases. What you need to remember is that there are two risks that come with corporate deposits. One is that they are unsecured loans, which you are actually giving to the entity, and therefore to that extent, you do come low down in the list of those people who are going to be paid back in case there is a problem. And the second thing you need to keep in mind when you're dealing with corporate deposits is that liquidity on those instruments uh, is comes with a much higher penal cost, and there is the ability in many of those deposits for them not to pay you back prematurely, because it's at the discretion of the management. So what is important to keep in mind is that you may be compromising a little bit on the liquidity and on the safety aspects when you actually buy a corporate deposit. The other category is, companies which are not NBFCs. These do not have to be rated, and there the risk tends to be much higher. And if you look at a lot of the defaults that have happened traditionally, in the NBFC space, in the corporate deposit space, you'll find a lot of it has happened in these sort of non-NBFC businesses. And therefore, it's important not to just chase the return as far as this category is concerned, but be sure that you're doing some due diligence on the quality of balance sheet, on what kind of profits the business is making, etc. Because you don't want to be, caught at the wrong end by chasing that 1% extra and then finding that the principal itself has become at risk.
Understood. Teena, your comments. Of course, Mr. Dhawan has pointed out how one should definitely look at avoiding lower rated companies because they may have higher risks over here. Of course, we also know that in the liquidity factor, the deposits cannot be broken in the first 3 months, and thereafter a prepayment penalty for premature withdrawal will also be put. So those are some of the risks that one should definitely look at. Who exactly should be approaching the corporate fixed deposits?
So, as Mr. Dhawan said, they have high risk. So definitely, you should not be swayed away by the high interest rate given by these corporate FDs, because there is the risk factor which should be properly understood. So my advice is, it's always better to diversify your portfolio. So it's better to have your funds diversified in 3 4 corporate deposits if you have a large base, and therefore in high risk, your highest risk will be mitigated. So I will ideally say that it should not be more than 10 to 5% of your overall portfolio in these deposits, considering the high interest rate. So to get the average return higher, it's always better to have the bigger portfolio or diversified portfolio.
Okay, Mr. Dhawan, let's now come to the RBI bonds and understand what exactly are these bonds. Who should be looking at investing in RBI bonds? Where can one really buy them or invest in them from? And what are the risks and rewards that one should remember?
So the RBI floating rate bonds actually, came back in 2020 as more a floating rate instrument where it's linked to the NSE rate. And there's a premium over the NSE rate that typically gets given of 0.35% on that. So what happens is these are essentially 7-year instruments. They compulsorily pay out interest to you every half year. So if you're looking for a cumulative option, for example, they don't have one. You need to
Okay,
necessarily get the payout every 6 months.
okay,
And the interest rate gets reset every 6 months. So for, from 2020 onwards, till the end of 22, the rates remained at about 7.15. It's only in January of 23 that they went up to 7.35% for investors. So it's an option. It's a 7-year option. It gives you a slight premium to what maybe fixed deposits are giving you today if you're not a senior citizen. But you need to remember that these rates can both go up and go down. And we need to remember that over a 7-year period, you could end up finding that your rates could therefore be moving, up and down depending on how the interest rates are at that particular point.
Okay. Also, let me just bring in the government securities and T-bills right up there as well and discuss that too. Are the, risks and rewards similar to RBI bonds right here? Who should be approaching them? Also, Mr. Dhawan, if you could just give in your insights first and then I'll go to Teena on both.
Yeah, so this is a sort of interesting option for investors to now look at because RBI has been doing a lot of work to get, retail participation happening through a direct platform that they've created. The advantage of going to a GSEC typically is that you can choose different tenures. And that's useful because very often you might find that you don't necessarily want to lock in your money on a 7-year RBI bond because you may not have that visibility, or you may just say that, what if I need liquidity during this period? I need to have the ability to actually exit if that happens. So clearly, GSECs are an option, T-bills are an option. As interest rates have moved up, these rates have also moved up quite substantially. The 10-year today is interestingly very close to 735 itself. And then depending on the tenure, these rates can be different. I think what we need to keep in mind is that the interest, once again, is fully taxable. And therefore, what ends up happening for a lot of investors who are in the higher tax brackets is that they tend to prefer buying GSECs and T-bills through an instrument like a mutual fund, where you get a capital gain income instead of buying it through a security directly or a government security directly, where the income will get taxed in your hands. And we need to remember that for many fixed income investors, they don't necessarily need cash flows every 6 months or every 1 year because they may be in a job where there's already income coming in. They're really trying to save money from a longer term perspective, and therefore they don't need that income which is actually coming through.
Absolutely. So those are the factors that one must definitely remember if one needs to explore beyond the, fixed deposits of corporate or bank deposits, small finance deposits, and you're going ahead for bonds and securities and T-bills that are offered by the RBI and the government as well. Teena, any point that you would want to make in either of these? What are the other risks one should keep in mind?
I think it has been already well covered. I only want to add that now it is very easy to buy these bonds. RBI has opened this platform called RBI Retail Direct Platform where you can register yourself and buy these bonds. So earlier it was not so easy to participate in the
Sure.
issuance of such bonds, but now you can. And the main thing about them is there is sovereign guarantee. So these are risk-free bonds, the risk-free investments, which are giving you higher interest today. So definitely a good point to be to buy these bonds as at this point of time.
Okay. Let me also interestingly bring in two schemes that were in fact touched upon by the government in the recent budgetary announcements. One was the Senior Citizens Savings Scheme, where the limit has been enhanced to 30 lakh now, and also a new announcement of a scheme that was made by Finance Minister Nirmala Sitharaman, and that was on the Mahila Samman Savings Certificate. Now, Mr. Dhawan, how do you really look at these two schemes in the current light of the interest rates that are being offered right here? And should one really be making the maximum amount of benefit that is being offered right here for all the retail investors?
So I think the Senior Citizen Savings Scheme, ever since it got launched in 2004, has actually been a very attractive scheme for senior citizens because it's tended to pay a little more than what you get on interest rates otherwise. And with the rates being at about 8% as per the last revision, it does make it an attractive option.
Yeah.
The way we look at it is it pays out quarterly interest, which is what a lot of senior citizens actually want. In fact, they'd probably love it if they got it monthly instead of quarterly, but that's how the scheme is structured. It has a 5-year tenure. It can be extended by another 3 years. It has some liquidity provisions with a penalty available. And I think this enhancement of limit has actually helped, because clearly just inflation over the last, close to 20 years would have meant that, if you were okay with having a 15 lakh per person limit earlier, you
Sure.
now need a much larger limit just to keep up with inflation. And then if you
Correct.
can put you and your spouse together, you can now do 60 lakhs. So we
Yeah.
think it's a very, very attractive option. I think senior citizens should consider enhancing their exposure if
Okay.
they've got any of that, if they've only used a part of it. If they've not done any of it, definitely look at it.
Okay. If
Uh,
you've not done any of it, definitely look at it. Yes, Mr. Dhawan.
Yes. And as far as the Mahila Saman scheme is concerned, very early days yet, not all information available,
Yeah.
but the intent is to do about 7.5%. 2 years. It's going to be a limited sort of offering period, only for available for 2 years. The taxability is a little unclear at this particular point, but there is a
Right.
limit of lakh rupees that you can put in there. So to that extent, it may not be that attractive unless the returns from there are made tax free for some reason. Because as you can see, other instruments today, a lot of them are giving you returns which are between 7 and 7.5% anyway.
Yes.
So I
Yes.
think we need to wait to understand this in a little more detail.
Okay, noted that. Let me now come to the post office deposits and also the good old public provident fund. Teena, let me just ask you as well. About 1 year to 5 years is the tenure for post office deposits that we get. About 6.6 to 7% of a return is what we get here. On PPF, we all know it's a long-term investment product, 15 years of a lock-in right there. And 7.1% is the kind of return that we get. Now, compare this with the FDs that we have seen and the small saving schemes, which most of them are actually offering similar returns. Do post office deposits and PPF still hold value, are still attractive enough despite the long duration that one needs to keep their money locked in PPF? Even in the current scenario, when some of the small, fixed deposits of some of the banks, including SBI, are actually giving you 9% return.
Yes, Sakshi, I will always say that one should invest in PPF because PPF has many tax advantages, and I tell you what these tax advantages are. First of all, PPF gives you 80C deduction, which is not available in case of many other instruments. Like in FD, you have to do, or the tenure has to be 5 years. But here, every PPF investment has 80C deduction. Then the most important part is whatever interest you get on PPF, it is tax free. No other instrument in my knowledge currently is giving interest which is tax free. So that's the one major factor for PPF. And the effective yield, effective interest rate, therefore in case of interest, in case of PPF, may be higher than the FD rates. So definitely PPF is one thing you should have in your portfolio. You should invest every year. In fact, April 1 is coming, so before April 1st, if you invest 1.5 lakh in your PPF, you can get the maximum interest advantage for the overall year. And one thing is FD, as I said, it's taxable, and in case of in case of time deposit also from post office, the interest element is taxable. So PPF is therefore has an advantage, and one should have it in the portfolio. And again, in the case of PPF, you have this provision where you can extend it even after 15 years. So after 15 years, you can continue your PPF. It's not that the tenure is limited to 15 years. So after that, every year you can make a withdrawal. So that way, it's the liquidity is good after 15 years. Before 15 years, also liquidity is there. But certainly, PPF has many benefits.
Okay, Mr. Dhawan, would you also weigh in on that, on PPF? Or what if the government's now focus is to make the new tax regime more attractive? They want the entire population sooner or later to completely shift to the new tax regime. Once the attractiveness of deductions really goes away, will this still hold an important investment tool for investors?
So I think there are two elements, like Tina was mentioning. One is the tax benefit that you get when you make the investment under Section 80C. And that certainly will not be an attractive proposition, if someone does end up opting for the new tax regime, or that becomes the sort of preferred route for everyone as we move forward. But clearly, the exemption available on the interest component still makes it a very, very attractive option. So I would say that, as long as you can put away your money for the long term and fixed income, um, uh, even without the tax benefit at the time of investment, it's a very attractive proposition for those in the higher tax brackets.
Sure.
I think it's very, very important to distinguish this. I think what tends to happen is, very often, one looks for fixed income solutions and assumes that they are the same options for everyone. But
Yeah.
clearly, PPF as an option is much, much more attractive to
Okay.
the people in the higher tax brackets, because that 7.1% is actually a much higher pre-tax number.
Okay.
Of course, it has a limitation of being able to put away only, 150,000 rupees per person per year. So to that extent, you can't, put away a whole lot of money, but use it to your advantage. And like Teena said, if you can do it in April, you can get the benefit for the entire year.
Okay, okay, understood that. We have two or three more options that we have to discuss. So let me just quickly go on to them. The next one that I'm going to be discussing is the liquid or the overnight mutual funds, the active debt mutual funds, which are other than liquid, and also the target maturity funds. On this, Teena, let me come to you first. What is the kind of, attractive offers that one can really look at in these kind of an options available, apart from the equity funds, if one wants to diversify into these specific fixed income options in mutual funds category, which ones would you be really you weighing in on?
Definitely, Sakshi. Right now, the time is good for debt funds. In 2022, debt funds didn't perform well, but now the scenario, because interest rates are near their peak, it is good time to go in debt funds. And when you have to choose, I will say that go in short or medium term duration funds, because there the risk is, if you go for long term, the risk is higher. So at this point of time, I will suggest to go in short term or mid term debt funds, where the return can be between 6 to 8%, whatever given, depending on your duration. And in case of, if you have short term needs, you can also consider liquid funds instead of FDs. They also are giving around a return of around 5 to 6%. And another reason for investing in debt fund is the tax advantage they have over fixed deposit. So in case of debt funds, yeah, the long term capital gain is taxed at 20% with indexation. And long term long term capital gain is defined for securities which are held for more than 3 years, three or more than 3 years. So definitely 20% with tax, with indexation benefit, is the reason to go for debt fund, because here the tax liability will be much lower compared to FDs. So right now, when the interest rates are near their peak almost, so good time to go in debt fund, because debt funds held to maturity yield is also higher compared to what it was giving in the past. Currently, it is around 7.5%. So
Yeah.
definitely debt funds I will say to go for.
Okay, Mr. Dhawan, your views over here, target maturity funds, active debt mutual funds, or the liquid overnight mutual funds?
So I think, I agree completely with Tina that, for again, for high tax sort of individuals, mutual funds are a very, very good option, because of the tax benefits that you get there, through capital gains, instead of having to pay marginal tax rates. What additionally needs to be done here is that, one of the big things that has happened with the introduction of target maturity funds has been the lower expenses that have come with that category. And the fact that there is also liquidity available on a target maturity fund, which used to be one of the limitations on what used to be called as fixed maturity plans, or popularly called FMPs earlier.
Yeah.
So very, very clearly, target maturity funds are a good place. You can lock in your money for longer periods. Ideally, it's a good idea to think about some sort of laddering on your target maturity funds, because what could happen is, while we all believe that interest rates are sort of close to their peak at this point,
Hmm.
what we are not sure about is how interest rates will be maybe 3 years from today, 4 years, five
Sure.
years from today.
Sure.
And therefore, if you can buy them maturing, let's say some part maturing after 3 years, some after four, some after five, etc., you might then find that your reinvestment risk is getting reduced through this process of laddering.
Sure.
Active funds, again, good option on the short-term debt side or medium-term side. Just be aware of the credit quality that you're buying into, because one of the things that tends to happen is that, as an investor, it's always nicer to look at higher returns, but you need to see that the quality of underlying bonds is of good quality. So I think that's very, very important. Don't just chase the returns, but look at the expenses and look at the quality of the bonds as well.
Sure, sure. Okay, last two or three options that we are discussing on the show today would be the NCDs or the non-convertible debentures, now which can be purchased from stock exchanges. 1 to 10 years is the tenure that you're requested to invest in for, and 8 to 9% is the kind of return that one can expect here. The other one would be the market-linked debentures or MLDs. Here it is popular with the HNIs. For the tax arbitrage. However, the Union Budget or FY24 has suggested that it will be treated returns as the short-term capital gains tax, plugging in the tax arbitrage, and the returns that one can expect here for 1 to 2 years of tenure is 8 to 9%. And the third one that we'll be discussing now will be the debt AIFs, which is requested for deposits of up to 5 years with a 12 to 15% interest return. So that's the highest, but this also is aimed at the HNIs, and it tails the higher risk and needs the investment of upwards of 1 crore rupees. So ultimate HNIs is what it targets really. Mr. Dhawan, if you have to really choose between these for the common retail investor, what would you really suggest as the things that one should keep in mind before going in for these options as well?
So I think NCDs which are high rated are an option. Again, one needs to be careful about not chasing the return here, because at the end of the day, you could get a higher return if you go to a low rated NCD, but then you're compromising potentially your principal. So we would say, if at all you want to go here, stay with the highest rated NCDs. Also keep in mind that while they are listed instruments, they may not have liquidity in the way that you would ideally like it. So you need to keep in mind that you may not be able to exit exactly when you want to. So that's a risk factor. As far as market-linked debentures are concerned, they did get a lot of attention because of the budgetary change that you spoke about. But we need to keep in mind that a lot of the MLDs are effectively instruments where there are derivatives which are used as an underlying instrument, and a portion of that money actually goes towards the lending business as well. So we would definitely believe that retail investors who do not understand these structures actually stay away from them, because I think they may be going into spaces which they don't fully understand. HNIs can look at it, but again, with the tax arbitrage going away, it may be a less attractive instrument going forward. The AIFs on the debt side, I think it's very important to keep in mind that they are definitely buying lower rated sort of instruments very often, and therefore the risk that they are taking is much higher, and therefore the return potential that one talks about is a little higher. You need to keep in mind that they could also be quite expensive. So when you're looking at this as an instrument, as an HNI, you need to balance off the return as well as the expense that you end up paying on those instruments and see what that net outcome is. And you should be comfortable with the money getting locked in for that tenure without much liquidity as well.
Very true, very true. So we've discussed most of these options from fixed income instruments that are available out there, and they may now attract higher interest after these consecutive 6 hikes that we've seen from the RBI. And what do experts, both Mr. Dhawan and Teena have really weighed in on as to how should you be really choosing them. But last word from both of you, top 2 or 3 instruments from these that we have discussed that you would urge investors to now really look at as an investment option. Mr. Dhawan, first you.
So I would say number one is target maturity funds, because you're able to lock into some of the higher interest rates. Look at it very carefully. Second is look at the option of a bank deposit. I think rates are up. For a portion of your money, bank deposits continue to be a good choice. And number 3, look at the PPF. Continues to be a very attractive option for people who are in a high tax bracket.
Okay, Teena, what about you? Your top 3 preferences?
Yeah. So I will say definitely good time to enter into debt funds with short to medium term duration. And then again, FD rates are giving very good return. If you are conservative investor and you do not want any risk in your portfolio, good time to lock in your FD rates. But if you are okay with fluctuations in return, then debt funds are better. But you have to understand the risk part also. And again, in the end, I will say that PPF for small investors is the good option to be invested because of the tax efficient returns it gives. So definitely these three are my options.
Okay, so I think PPF and bank FDs were the common ones between both of you. But thank you so much, Mr. Dhawan and Teena, for weighing in on these various options and helping all our viewers get clarity on 5 accounts. We've discussed these about 10, 11 options that are available for you in the fixed income market that you can now explore. So based on tenure, on interest rate, on the liquidity factor, on risks and rewards that you should judge these instruments as a potential investment option right now in the current scenario, all out there for you. I hope really all of you got a clarity as to how should you be approaching these instruments now. Many thanks, Mr. Dhawan and Teena, once again for sharing with us all these deep insights into the fixed income market. Thank you so much.
Thank you very
Thanks,
much.
Sakshi.
All right, and with that, we wrap up this edition on Business Today TV. News flows will continue from the world of business and stock markets and also from personal finance. So do stay tuned on to Business Today TV for a whole lot more. Many thanks for tuning in.